Great. So we've got a panel now coming up on policy. So systems change. People talked about systems change, where it's at. Well, policy is going to be one of the great levers for that. I will make a shout out also for the UK Stewardship Code 2020. If you haven't seen it, this is going to be maybe one of the big policy levers. So fund managers, asset analysts, and people in the room do have a look at that. I think we've heard from the asset owners, there is more that we need to do and more going to be on our shoulders in terms of stewardship and engagement. And I think that code is going to push us to do more. So I'm going to invite Nick, Mark, Rachel, and Anna to come up and join me. I'm just going to do a really little intro for them, and then we'll really get to the meat of it. I'm also going to be on the phone a little bit, just to say, if you want to ask a question, it's going to be coming through this app, on Activity app. So particularly as I'm not going to be answering them, all the difficult questions here, systems change, these are our thought leaders who are going to change things. So Nick is now with the Grantham Research Institute, but he's done work with the UN Environment Inquiry. He was on the buy side. He's been involved in climate change, all around great thinker. Mark has been involved in energy research, utility research, sell side, carbon tracker, now with BNP on sustainability. Rachel's been in policy work, civil service, now, as we've heard, is leading investors on climate change. And Anna is working on the Climate Bonds Initiative, done a lot of work on taxonomy, and we can speak kind of slightly beyond just listed equity to what's happening in bond and fixed income in other markets. And I think I'm going to go, we're going to go Nick, Anna, Mark, Rachel as a sort of intro as to what we're doing in that. So if you do have any questions which come up, definitely do put them on the app, and we'll take it from there. So Nick, go ahead.
Well, thanks very much, Ben. Thanks very much for inviting me. It's very good to have that warm-up in the last panel about policy. And I suppose just the thoughts are that fund managers and analysts both need to take a view on policy, and also, as we heard, potentially get involved in policy. So there's sort of two roles there. Maybe just some sort of thoughts. Clearly, the reason policy is important is because we have big market failures, most clearly around climate change. We have missing markets as well. The IMF has identified that we have perhaps a sort of $5 trillion bet, which is placed by not pricing carbon, by actually government subsidizing. So that's why one of the reasons why we need to get involved in policy. The big change, obviously, is now that actually we're not just talking about the real economy, but the financial system itself. We now have 46 central banks who are actively involved in thinking about what this means for them in terms of climate change, thinking about risk, thinking about scaling up green finance, and also changing their own portfolios. They're addressing many of the other issues. One thing maybe just to throw in is that the pace of change is quite substantial. It's actually in terms of policy, it's moving very, very quickly, but we're really only in the foothills. And I think we should think about policy in the round and think systemically. That obviously we'll talk a lot on this panel about climate change, but we have a sort of climate and environmental crisis, particularly policy around biodiversity and nature is very weak. And we need to think about environmental policies and climate policies, but also about what that means for the overall inclusive development and so on.
Great. So yeah, doesn't live in a silo. I know your work has been around just transition. We've also had carbon tax, natural capital, but intersectional with a lot of these things. Social justice. How do we make real world impact? As we were talking about earlier, doesn't necessarily just live in a bubble. We've got to work on all of these factors, which is a good kind of segue into what climate bonds and what fixed income and what debt investors and collaborators may be able to do in this part of the world.
Yeah, so I just wanted to mention really two policy initiatives and movements that are quite interesting and critical at the moment. And interestingly, one is coming at it from the green side and one more from the brown side, which is quite a nice balance. So as many of you probably know, the EU, the Commission set up a technical expert group in March time last year to develop 4 things, but one of them was a sustainability taxonomy, a classification system for what would count as green. And the intention of it is for people who have green funds or green bonds or anything that's labelled green, to disclose what proportion of that meets the criteria in the taxonomy. It's definitely not about you have to only invest according to the taxonomy, it's just disclosure against what's in the taxonomy. And really what it's trying to do is set a benchmark for actually, this is really green. And the kind of underlying principle on the mitigation side is that the criteria have been set so that you were trying to establish what is compatible with a net zero economy by 2050. So it is ambitious. There's a lot of transition in there as well. It's not just about mitigation. There's 6 environmental factors at the moment, but it's called a sustainability taxonomy. The intention is to broaden it to other social factors to cover the full range of SDGs as well over time. It's quite an undertaking, but that is the plan. And at the moment, the date at which this will become sort of ready for use is kind of a bit of a political game at the moment, but it's looking like early 2022. But obviously it will be out there earlier so people can start using it. I think this will be a bit of a challenge for people to start using it. There is quite a disclosure requirement around it, and the disclosure is a little bit different. So this isn't really about ESG per se, and it's not even about impact reporting per se, as people traditionally think about impact reporting, because again, on the mitigation side, what's embedded in it is criteria and thresholds compatible with rapid decarbonisation. So actually you're not trying to just say, this is my carbon footprint and this is how much better than it was before, or it's going to be this much better in 10 years than it is now. It's about, do I meet the decarbonisation trajectory that it's going to get us collectively to a net zero economy by 2050? And that is a bit of a different shift in thinking. Even for bonds, that can be tricky. Not everybody works on that basis, but for equity, because this also is to apply to equity funds, it's a bit of a shift. It's about actually looking at the underlying activities of the companies that you're investing in, and do they meet these kind of thresholds and metrics. So it's a different take on it, which is interesting. The other one, just very quickly, is coming at it from the Brown side, is obviously, like it's already been slightly mentioned, the central banks, who obviously are increasingly talking about actually what are the impacts of climate on financial stability, where are we increasing our climate risks, and doing a lot of work at that at the moment in terms of thinking about brown assets, so the assets and the activities that are going to pose a financial risk. And then it's a different question. You might need a brown taxonomy, and some central banks are pushing to develop a brown taxonomy so we can very clearly understand, all of us, actually what should we be wary of and making transition strategies for that we might see as potential stranded assets, either because of the carbon impacts of them or because of physical climate risks that make them actually not well adapted or resilient to climate change that is coming, those kind of things. And as part of that as well, they're sort of obviously looking to develop stress tests for actually what it means in different climate scenarios for these kind of assets, which are often very context specific when we're talking about adaptation and resilience. So them getting into that space, I think, is really important. At the moment, they're not really mandating for people to actually disclose or somehow change their investment strategies, but a lot of them are requesting disclosure on these kind of climate risk issues. Some are requiring disclosure in Brazil and France, I think, are the 2 good examples there. So there is more of a movement, and I think it's interesting that there is a lot of movement now from central banks. We've talked about the EU taxonomy, but a lot of other countries as well. A lot of regulators are looking at developing their own localized taxonomy. Canada, Japan, some countries in Latin America, for example. And a few years ago, CBI has been working on a taxonomy to be used on a voluntary basis in the green bond market for quite a few years, and it has good traction in the green bond market. But we've been doing it for a while, and people are like, oh, our taxonomy is never going to catch on. People are just going to determine what green is for themselves. And so this shift to having regulatory bodies try and set benchmarks around what is green and conversely what is brown, I think is quite a significant shift.
Great. So policy levers coming on sort of,
Yeah.
I said greening finance, I guess, and financing green, which is part of what we talked about. Yeah. Mark, so what are asset managers, leading asset managers meant to be doing with all of this?
Yeah, well, that's a big question. Let me talk first of all on the issue of policy, and then I'll come back specifically to what asset managers are doing, because I think the way you have to think about this, I mean, policy is clearly extremely important, but it's how policy interacts with the other actors. And it's about establishing, I think, a virtuous feedback loop between policy and technology initially. Because at the end of the day, look, we're here all financial market specialists, but it's about effecting change in the real economy. That's how we're going to solve the problem of climate change. And so when you think about, and then it's about how asset managers respond to those real signals. And if you think about what we've seen in the last 15 years, I mean, I think there are grounds for great optimism about our ability to tackle this problem. If you reduce it to the following very simple equation, that 70% of greenhouse gas emissions are from energy, so we really have to decarbonise energy. That's the number one issue. If we can solve that, we're 70% of the way towards solving climate change. Now, in the last 15 years, the progress on renewable energy has been much greater than anybody thought possible 15 years ago. I know that because, you know, I've been following the utility industry for 25 years. I was working in the utility industry 15 years ago when wind and solar were responsible for 5% of production in Europe, in Germany specifically. And if you'd said 15 years ago, wind and solar will account for 35% of German power production by 2019, in only 15 years, people would have laughed in your face. I mean, the conventional wisdom was this was going to be a very slow process. What happened was policy was put in place that attracted capital, you know, yes, initially at a very high price. You know, there was a subsidy to be paid, but the subsidy attracted capital, and the capital drove down costs much more quickly than anybody thought possible. I mean, much more quickly, right? And so you had this virtuous feedback loop established between policy and technology. You get a policy-technology response, you get economies of scale, it drives down costs, you get better at doing stuff because you learn by doing. And as the cost comes down, it becomes easier for policymakers to set more ambitious targets. I think that's why we got a climate change deal in Paris, where we did not get one in Copenhagen, because the cost of renewable energy fell so much between 2009 and 2015 because of this feedback loop, this virtuous feedback loop being put in place. Now, the reason I say I'm more optimistic, I get more optimistic the longer I work in this field, actually. If you take Copenhagen as the low point of how everybody who was following climate change at that time, you know, it was a very disappointing outcome at Copenhagen. But we've made so much progress in the last 10 years with the cost of renewables coming down. And now you have these extra levers that are driving that positive feedback loop. And those extra levers are, the one hand, investors. You know, I mentioned it's all about the relationship between investors and the real economy, but we have to focus on the real economy first. And then you can come in as investors and think, okay, how can we help to move the needle further? We see there's a positive feedback loop in place here. How do we piggyback on that? How do we help to accelerate and intensify it? And the way we do that is we encourage companies to perform better on these issues, and that helps drive the technology part of the feedback loop. And now you have this other extra part of the equation, which is rapidly increasing societal pressure on climate change, which helps drive the other side of the virtuous feedback loop, which is government policy. So all of these things are accelerating and intensifying the positive feedback loop all the time. So the more you look at this, you more think, well, actually, we've got costs down for decarbonising the main source of greenhouse gas emissions much more quickly than we thought we would 10 years ago. The big challenge now is storage. So the question is, how do we repeat the success of the last 10 years and drive down the costs of storage? And I think now that investors are much more actively playing in this field, helping, you know, so to the second part of, well, the first part of your question, but the second part of how I chose to answer it. How can investors help this? Now we're at a stage where we can start offering funds and products that will help drive that. We've just launched an energy transition fund 2 months ago to play exactly these themes, offering investors a chance to invest not only in renewable energy producers, but in the manufacturers that produce the kit that drives this, energy efficiency solutions, and so on. And we think there is huge appetite for that out in the market. It's only been running 2 months, but we're already performing, you know, the performance is very good. So, and interlinked with that, as Anna said, you know, policymakers are now pushing not just on the real economy, but on the financial system as well, with the taxonomy,
we'll come back to your
TCFD, and so on.
positive feedback loop idea, because one of the challenges is actually there's still at least 50% in very hard to abate sectors like fertilizer, our land economy, agriculture, cement, flying, plastics, aluminium, steel, we can go on. But I'd like to bring Rachel in to maybe comment a little bit about how well collaborative engagement is going, and also a little bit about what you might have talked from the policy point of view from the work you've been doing.
Yeah, thank you, Ben. I mean, I think from my perspective, we are seeing increased engagement from investors on policy, which is very positive. I think a lot of that has been driven by the work in Brussels on sustainable finance, where investors are now seeing that the policy eye of Sauron, as it were, is focused on them rather than the real economy. So that has helped to focus minds a lot. And I think that work done by, as well, people like Mark Carney and the Bank of England on TCFD has also really helped to focus in on what the policy implications of this agenda are for investors. So that's all been quite positive. As Mark was saying, the real economy is still an enormous part of this, and investors that have holdings across very heavy emitting sectors still have clear drivers for ensuring that policy measures are taken that are going to help to manage the risks in those sectors and exploit the opportunities that we see with emerging technologies. So I think all of this is helping to keep investors focused on the issue. We've seen some real successes over the last 12 months or so with big collaborative engagements, and on the previous panel Edward mentioned the Global Investor Statement on Climate Change, which we coordinate at IIGCC with partners from around the world, and we've now got 515 signatories to that statement with well over $35 trillion in assets under management. And it's a quite straightforward ask on world governments to implement the goals of the Paris Agreement to get to 1.5. That means scaling up their national determined contributions, putting long-term strategies in place, implementing policies that will drive capital into low carbon and climate resilient areas such as carbon pricing, fossil fuel subsidy phase out, coal phase out, and then also implementing the recommendations of the TCFD. So that's now at a record-breaking number of investors, which is really positive. And we even had the Secretary General of the UN reference the statement in his closing remarks at the summit that he held in September. So we do see it having impact and resonating at the global level, which is fantastic. What I think is also helpful is that investors are taking those messages to at a more kind of regional and national level now. And the work that we do within Europe is about translating those global asks into concrete policy measures within the EU. So we're doing a lot of work, for example, on what a net zero emissions target means in practice for both the EU and the UK after their recent legislation for a net zero target. And this will mean obviously big changes both for the finance sector and also for the real economy, and some real challenges, as we've heard as well. Some of the sectors that you mentioned where we know that mitigating down to zero won't be possible. So what does that mean then for policies around carbon absorption strategies and capture technologies and those kinds of things? Yeah.
So one of the challenges I get from some stakeholders is it's quite easy to sign on to these kind of statements, but how are people actually doing the engagement, and is it really as successful as some of the messaging would be given the scale of change? And actually, to Nick's point, there has been quite a lot of policy change, but there still is the perception that it's not quick enough. And do you have any comments to sort of that sort of challenge?
Yeah, I mean, I think it is a mixed bag. We see some really engaged leaders, particularly within the group that I manage, that mostly engage with the EU institutions, where we'll take groups of investors to Brussels. We'll have meetings where we brief members of the European Parliament, national diplomats, European Commission officials, or even commissioners. We'll write letters, we'll send in policy reports and analysis with the investor case for what investable policy measures could look like. We'll even help with drafting amendments, so that there's a whole range of different activities that investors can get involved in depending on what they're comfortable with doing, because obviously it can vary by organisation and also what they have the capacity to do. But organisations like ours exist to support those efforts and to bring you into the conversation, to have a role in whatever way that you're comfortable with. Great. So the support is there to
the
do
message
that.
It's happening, and you can get on board the ship.
Absolutely.
So maybe we'll ask the question that Fiona answered earlier in the session today, which is if you had one policy wish, or maybe there's one policy barrier which you'd like to have sort of disappear, what is the kind of thing either from your group or organisation that you think you would do? I'll go back to Nick and then go in the sort of same order on that.
Well, if I can cheat,
yeah, you can cheat.
I can give two. So one very parochial. This summer, actually, as I say, last summer, time moves very quickly. The UK government released its own green finance strategy and made very clear that it was going to keep in line with the regulatory systems developed by the EU, which I think is, particularly given all that we've seen, is very important. So my one hope is that whichever government's going to get out of this new election we're having will stay with that to actually keep alignment with EU policies on sustainable finance. So that's a tiny thing. I think the big thing is that most of the investment we're talking about in this area is going to be in developing and emerging markets. And we now are in a fantastic position. So we have 35 trillion of investor capital, say latent, ready to back Paris Agreement. banking sector has just put in 47 trillion behind their new principles of responsible banking. The multilateral development banks have now come up, the national development banks, but we still have this problem of actually sort of pipeline, particularly in developing and emerging economies, to actually how are we going to deliver this capital into projects on the ground in the energy sector, in the transport sector, and so on. So I think something which brings together that work of the multilateral development banks and investors and the commercial banks would be very important. So actually it hits on the ground in developing and emerging economies.
Great. Anna?
Yeah, we've done a bit of work recently on thinking about what central banks are doing and can do. And there's a lot of recommendations in there, or requests or asks for central banks, and around developing a brown taxonomy so that people know where their risks may be, giving guidance on how to do climate stress tests, that people actually can make an evaluation, an informed evaluation, a consistent evaluation as well. But also I think there's a lot to be said about the central banks can do more to lead by example, I think, with their own investments that they've got, which are huge. And I think that would actually be a really good place to start. And you could start just with their own investments. You could extend it to quantitative easing, and putting more of a green spin on that as well. And those kind of things would make such a big difference.
Choose one then. Their own investment.
If I just put the central banks lead by example with their own, what they can do to direct towards green, and then that covers quite a lot of things, but I think that would be quite impactful and help to develop and flesh out some of the issues and the challenges in this, if they're actually doing it themselves as well, would help to help everybody else to do it along the line. Yeah.
Sure. Mark? You choose one.
Yeah, very boring, very easy. More widespread carbon pricing.
Carbon
I think.
pricing.
Yeah, I mean,
and would you combine that with a carbon dividend to ease the just transition type ideas, or do you think actually just the signal that we need to consume less, or in a more bended way, means that we don't need to think about
I think
that?
you can definitely play into this idea of a just transition, absolutely. But I mean, I think just think of. We know that carbon pricing works. Look at the UK, right? It's had a carbon price effectively of £35 a megawatt hour for the last 2 years, and coal has left the UK generation mix, right? So we know it works.
I'm going to pause you on that then and ask you, do you think we, or everyone, or asset managers then, should be asking our investee companies, all of them, really to be advocating this? So this kind of came up earlier about public policy, about something, because it is all companies, obviously some are more than that.
But I think
because if you had all of the CEOs, rather than say a business roundtable said, actually we all support a carbon tax, right? Would that go through, or is that
I think
where
there's a
we're
lot of
gonna
fuzzy
sit?
thinking about this. I mean, I think to cut through, you know, we have a carbon price at the moment that's only doing half the job, and there's only 13% of emissions globally that is covered by it, right? So we have to start thinking much more clearly about targeting it properly and making it work properly, which the UK, to its credit, has done. But there's a third leg. So, you know, you can think about this in standard economic theory. There is the static efficiency argument, the dynamic efficiency argument, and the allocative efficiency argument. Static efficiency is the price is high enough to get change between different. So,
but who's going to be advocating for it?
Well, everybody should be.
So it is
policymakers and investors. Yeah.
And an investors doing enough?
Well, we're trying. I mean, you know,
that's the challenge that a lot of stakeholders think broadly as an asset management industry that we haven't been doing enough, and we're not doing enough. So that was kind of where it's going. Nick?
And maybe one point is actually to not keep promoting things which sound good but actually are just fanciful. So a single global carbon price.
Oh yeah, I mean,
because actually that's never going to happen. In this country, we have different carbon prices for electricity, heat, not priced enough. Transport price very high, kerosene, and so on.
Rates, I guess.
So I think recognising there are carbon pricing, rather than the idea we've got to wait for one single carbon price.
Yeah, and one concrete example from the asset management industry, which I think is going to be a very big deal in the next couple of years, is we're finally getting into Scope 3 as a big deal. And all these industries that have had a free ride and haven't had to worry about the economic impact of their carbon footprint, like the fashion industry and the clothing industry, the food industry, whose supply chain emissions are enormous. So I think bringing a spotlight onto those companies and saying, we're pushing for carbon pricing, it's going to ripple through your entire supply chain. You need to get smart about how you manage your supply chain. I think that's one very obvious area where the asset management industry can bring a focus and pressure on industries that frankly aren't doing enough to manage their carbon emissions.
And Rachel, one one bullet policy, what would you go for?
I mean, I agree completely. If we were able to just wave a magic wand, for me, it would be carbon pricing as well. But within the kind of political reality that
you could choose
we're
another
operating
one.
in, we're a slight cheat answer as well. But for me, it's really whatever policy you're looking at, just making it consistent with the 1.5 degree goal of the Paris Agreement. Because in that way, you can build on what made Paris a success, which was that it's bottom up. So each country can look at what the right policy framework, what the right energy mix is for them, as long as it's using 1.5 as its anchor and it's basing its policy plans on a pathway towards achieving that goal, then that for me would represent a real success.
Great. Okay, we'll take some questions from the app. So we have one here basically saying that a lot of the oil giants are culturally unwilling to devote their huge resources to developing renewable energy alternatives. I can actually throw out some figures. I have this sort of crazy one. So US military R&D spend, so this military R&D, so this is just the R&D, not the kind of missiles and the planes, $78 billion a year. Netflix content spend, $15 billion a year. UK commitment is now $1 billion on green tech. I think we're going to go up to $2 billion. So huge underspending on innovation. And I think Shell's R&D budget on general energy, so not even green energy, is about $1 billion. So the scale of that, are they really going to kind of bend? Is it kind of fanciful to think that regulation and government is really going to engender this or to divert this, or is there another lever that we need?
Well, it was fanciful to think that 15 years ago in the power industry, and the power industries that didn't invest have lost, 80% of their market value. So the oil and the problem here is
saying market forces will do it.
Yes, I think they will, because especially as we've got renewables to a state where it's the cheapest form of energy now. The issue here is not really an economic one anymore, because renewables are palpably cheaper than anything else. It's a psychological one. These
political will.
Or big oil companies are in the same place that the utilities were in 10, 15 years ago, which is, oh look, I can make much higher returns in the upstream part of my value chain than I can by investing in renewables. But the point is, you won't be able to make those returns in the future as you were in the past, because you've now got to compete with this new source of energy, which has a short-run marginal cost of zero and whose capital costs are falling like a stone. Sure. So, you just have, that's our duty as asset managers who invest in these companies, or who rather invest less and less in them, because the profitability perspectives are not as great anymore, to bring that out in market valuations. You're starting to see it. You're starting to see brokers downgrade. Redburn,
sure.
A month ago, downgraded the oil and gas sector as a sector because of climate change.
Rachel, Anna, are you as optimistic on that one?
Let's
suggest not quite. But,
well, it's not market forces alone, obviously. I don't want to sound naive on this, but the economics are there now.
Sure.
If the oil and gas companies are not acting, it's because there are other blockages, and the blockage is psychological, is my point.
Okay, Rachel, Nick, if you know.
I think market forces have a huge role to play, but that won't remove the need and the requirement for policy and regulation to continue to send those signals and to back up action that's been taken through other routes. We're seeing investors be very active with companies, including the oil and gas sector. We're a founding member of an initiative called Climate Action 100+, which is coordinating investor engagement and active ownership activities with the biggest emitting companies in the world. So obviously a huge amount of the oil and gas sector is caught within that, and it's a slow process and it's a very challenging one, but we are seeing impact in a positive way with companies now making new commitments on their operations, on their governance, on their strategy, on their lobbying practices. It varies by sector and Sure. It varies by company, but there are other avenues that investors can take as well as advocating for strong policy measures to try and influence the market forces too. Yeah.
Although I still hear from all my XR friends that they just think that a lot of investors aren't on board. We had some of the things about how voting patterns happen, whether that's passive or active within that. But do you feel that investors are bending and pivoting enough then on this?
I think so. Certainly, it's year 2 of a 5-year initiative, so
Sure.
we'll have to see what happens at the end of it, and there'll probably be some difficult decisions to then make around particularly companies that have been completely intransient and haven't been willing to budge at all. But
Not naming Exxon. Yeah.
But the number of investors that are now involved in this initiative is growing rapidly, and it's got to the point where it's difficult actually to share them between the different companies because there's so much appetite to have a role and to
Sure.
play. Yeah.
So Nick, maybe you want to comment, and maybe you can also take we've had a question about carbon pricing is really great to carbon, essentially the carbon-specific externalities. But to your earlier comments, there's other actually externalities that we can see here, whether that's water, whether that's migration, whether that's land use and other things like that. Do you think we're going to see the future of policy to also look at some of that, or is that also even more nascent?
No, that's a great point. So while I think about that tricky question, so I suppose on the oil and gas side, we have a model. We have the Danish oil and natural gas company, which is now Ørsted. And that's what the model is, that you move from an oil and gas company with coal assets and you move to something completely different. It's not staying as BP and Shell. It is making that full transition. Perhaps the other thing is that we know that most oil and gas is actually not in listed Western companies. It's in nationally state-owned companies. So I think that then speaks to what does this mean for sovereign level risk, particularly the major oil and gas producing countries around the world, and what risks do they face at the sovereign level with their state-owned assets as demand for oil starts to peak and as these issues move away. So I think that's a big issue. So on the other issues, it is much harder. Perhaps just in terms of sort of next year, the big climate conference, which will be held in Glasgow, if Scotland is still part of the UK. That will be, the focus will be oceans, so the relationship between climate and oceans. And there will be also a very big meeting in China on biodiversity. So I think that it is going to be a focus looking at, even in the environmental space, looking at other areas, so questions about soils, loss of biodiversity and so on. Work we're doing is actually looking at the relationship between natural capital and sovereign bond ratings in Argentina and Brazil. And is there any linkage there in the future? So I think that's going to be coming up fast and perhaps dragged on with climate, nature-based solutions and so on.
Great. Okay, we've got a couple of specific questions, although I'm not sure we're definitely going to be able to ask them. So one is on direct property investment. So I guess buildings are pretty big. I think it's like 8 to 10% globally in terms of carbon, but their data is really mixed. What can we do in terms of policy? Obviously, we have building standards, but is there anything more on that? And then we also have another question, which is about just regulation coming in. Do you think actually enough generalist asset managers are aware of the rising obligations that they have to integrate ESG, to maybe delve into what policy is doing and the obligations within them? So I'll sort of open it up if anyone has a view on direct property or the whole buildings carbon policy thing.
I can maybe cover that a little bit. So we saw some quite good progress in the EU when the Clean Energy Package was negotiated last year. Part of that was the Energy Performance of Buildings Directive, where a lot of efforts were made to increase energy efficiencies within buildings across the EU. So those new measures will be implemented over the coming years. Obviously, there'll be a question mark with the UK as to how much it decides to diverge. But I think within the UK, we've got quite strong domestic standards already, so I wouldn't expect that there'll be any reduction in ambition. It just may be that the measures themselves would vary slightly. In terms of what more can be done, I mean, I think there's still a way to go, and it's a very difficult sector in terms of the split incentives that you see. And but there's definitely more around kind of energy performance certificates, around retrofitting, that I think there's space there in the policy debate to be pushing for a lot more.
I think the point on retrofitting is the really important one, right? Because it's the housing stock that matters, and you can have new building regulations, and that's great, but it's the housing stock that's there. Yeah, and there was an innovative deal, I think, last year struck between our parent company, BNP Paribas, the bank, and E.ON in the UK to refinance mortgages that would allow for improving the efficiency, and you pay the loan back effectively with the energy savings that you make over the lifetime. I think because one of the issues here is that your average household doesn't think in terms of payback, in terms of IRR on a 3, 5, 10 year view.
It's just the capital cost.
Right. So that's a major psychological difference to that market. So policymakers have to get smart about that. But obviously there is a massive amount to be saved there.
Great.
Maybe just to extend Mark's policy feedback loop, I think now we're seeing actually interaction between the real economy policy, which Rachel was talking about in terms of building standards, and central banks, particularly now central banks scrutinizing the banks that they regulate to understand, actually, do they understand where their mortgage books are allocated? What proportion are in A, B, C, D, E, energy efficient houses? Where are they in terms of also flood risk as well? So I think that's another area we're going to see this dynamic between these two areas. So the first question every central bank is, do you know where your mortgage book is? Do you know where your commercial loan book is? And are you prepared for that tightening that is coming, whereby actually you could be sort of underwater because rental
and you're
property.
getting better data, geospatial, it's becoming cheaper, there's transparency. So I'm going to bring Anna in. Well, I'll also ask this question that people can think about while Anna's commenting, which is, I guess, emerging markets or the global south, which is what you sort of were commenting on. How do you develop and deliver renewable energy or a lot of these things to those citizens, given that it's very fragmented, the infrastructure isn't there? I guess a lot of the global north or some of the global north not necessarily willing to subsidize that, albeit that they use carbon budgets in the last 100 years. We'll have those think about that question. Well, Anna, you wanted to make some comments on the buildings or regulations side.
Yeah, on the regulation side, I agree. I think the building standards and building codes are a key thing because they're well used and well known in the industry. But I would make a plea. We've looked at them quite closely because we wanted to use them as a proxy indicator for good performance on emissions, compatible with a kind of 2-degree trajectory. And a lot of them are not very good. They don't correlate well with actually good performance in emissions because they're based on model data, on the design of the building, and they don't actually track to who is a high or low performer. So you could be A or B grade. It's not very good. So I'd actually wish that people would go back to those now. And maybe smart meters is going to help us here to actually have some real performance data, particularly for residential buildings, which is otherwise very difficult to get. So I think they are the tool, but they actually need a lot more work. And the same with the kind of industry standards as well that are used in the building sector. They need to be strengthened quite a lot to really link them to good climate mitigation outcomes. Yeah. And then just very quickly on the externalities point, I think it definitely is becoming a much bigger thing. Obviously, as we move into the SDGs, which we are, that brings in a whole range. And even the EU taxonomy, it has, I mentioned, 6 environmental factors. Climate mitigation, adaptation. The other 4 are water, pollution control, circular economy, and healthy ecosystems. And at the moment, the criteria around do no harm to those things. So that at least is a minimum bar. But over time, we also want to develop criteria for a substantial contribution to all of those factors as well. So definitely, there's a lot more work. And I think that's going to be critical because, and it's difficult at the moment, those things are done in a kind of qualitative way. And there needs to be a lot more work around actually more quantitative, simpler approaches, simpler metrics. So there's a lot of work to do around that to
rebuilding
make
natural
it,
capital and some of these other capitals.
Yeah, in a way that people can easily measure and report on as well. Sure. Yeah.
Then the last thing on the buildings thing, because I went to see a housing development just outside Copenhagen, 100% upcycled material, 70% lower carbon impact, 50% lower carbon impact going forward, SDG aligned. Those developments seem to be starting, although again, we can talk about the speed of that. So while you're thinking about answering, someone's going to do the tricky one in emerging markets, we also have another one about, despite a lot of policy, particularly European-centric, kind of why is Dong Orsted maybe one of our only transition examples, although I might throw in Neste in Finland in terms of green waste to energy, so maybe that's a little bit harsh to say it's the only one. So while people can think about that, I didn't know if anyone wanted to pick up on the comments about how do we deal with emerging markets, global south, given whether infrastructure or anything is that. I don't know, Rachel, Nick.
Yeah,
and we'll take the comments.
It's a really vital but difficult area, and just in the context of the global negotiations, we've talked about COP26 in Glasgow next year, and over the course of the next few months, the UK government in the presidency role will be putting a lot of pressure on all countries to scale up their national ambition and cut their emissions even further. For emerging and developing nations, obviously this comes with its own specific challenges, and if they're going to sign up to those kinds of new pledges, they need the confidence that there'll be finance to back that. So making sure they have confidence that capital can flow, whether that's through, whether it's private finance that's then supported by multilateral development banks, DFIs, if it's blended on the ground. It's a really important area that's not been quite right yet. So I know there's a lot of work going on, for example, in the World Bank at the moment to try and bring together all the relevant actors to look at how to improve this. But it feels like it's getting more urgent with no obvious solutions at the moment, unfortunately.
Nick?
I mean, one thing just to mention, I mean, China, whether that's an emerging economy now or emerged or whatever, but this has been, I mean, not just, I mean, some of the markets you were talking about, Mark, but also in terms of sort of the green finance, sustainable finance agenda. Without China, we would not be talking to the same degree. Without China, the EU would not be having a sustainable finance action plan. This is the new driver in terms of very activist green finance policy. So clearly they're on board. I mean, I think other countries to look at. India, interestingly, hasn't yet really picked up on sustainable finance. Their central bank hasn't yet done anything. Discussions about a sovereign bond coming out, maybe that could be green. South Africa, very interesting. Big issue there. A very failing coal-based economy, very serious sovereign issues, but very interesting discussions from the President, Cyril Ramaphosa, actually reaching out to the finance sector and says, I would like you to help me design a just transition transaction. We've got to wind down our coal. We've got to do the right thing by the workers and communities that rely on coal, and we've got to phase up renewables. How are you going to help me do this? So very, very, very interesting outreach.
Great, okay. Did you have a...
Yeah, just very quickly on that one. There's obviously a real mix in emerging economies. Some economies have a high reliance on hydro already, which can be high emissions or not, but it is a renewable energy source and it can be up to 50% of their power supply already. Other countries obviously are much more fossil fuel dependent, and there we see more challenges because, and especially where they have got populations not even connected to a grid. Actually, there needs to be a lot of investment in the grid network, even before we talk about the power going into it. But then often there's a desire to invest in gas, and it's seen as a transition and green because it's better than coal. So there is quite a discussion there about actually how quick is that transition going to be? Are we going to leapfrog or not? And there it's just a case of being really mindful of actually it's so tied up in the sustainable development. You can't just look at it as clean energy. It's actually how do we move a population that may have intermittent connections to power to something else which is reliable, that can power industry, that can generate the economic returns they need to help their economy grow. So, you know, is all those kind of things knitted together into it. Yeah.
Great. Okay, so we're coming up to the last 5 minutes. So we have a room of, I mean, actually this room is probably the top 1%, or is part of the top 1%. The big influencers within asset management or within the system. You know, we've got investors, we have asset owners, we have analysts, portfolio managers. If you have one ask for them to take away, either from your framework or policy, that they should go back and think about within their teams and their organizations, what ask would that be? So you have a minute to sort of say, you know, this is the room which could change the world, right? This is where it starts. Systemic change starts with the people. We are the systems change. What is that one thing that you would want to do? Who wants to go first? Otherwise, I can go reverse order, Anna backwards, unless... Yeah, okay, Anna.
It's fine. Yeah, I think because I come from it from a taxonomy point of view and the other pieces of work as well, I think it's really understand what is green and what isn't green, what is compatible with 1.5 degrees, what isn't, and then even understanding that from a theory point of view in terms of what you've got, how green is it or not, or how brown is it or not, and actually you can't really do anything until you know what you've got, and I think enough people aren't really asking the probing questions yet about what they do have or where they might want to go. Yeah.
So really understand what you're investing in.
Yeah.
Okay. Rachel.
For me, I think it's about looking at how you can support the outcomes of COP26 next year, because there's such a huge opportunity for the UK finance sector here in helping to deliver UK leadership that will help move the world to a 1.5 degree pathway. And there's a whole host of different actions that finance organisations can be taking, whether it's aligning your own portfolios with the goals of the Paris Agreement, whether it's putting more capital on the table for green solutions, whether it's engaging more with companies, whether it's telling government what policies are required to deliver on this, but reflect on how you can do that and then go and support the UK government in achieving it.
So just do something more than what you've been doing before.
Yeah. I would agree with Anna. I mean, I think you just have to make sure that the senior decision makers in all organisations really understand what's at stake here and how much has changed. I mean, so many people are stuck in this kind of notion that it's been very hard to keep up with the pace of change. I mentioned how quickly the cost of renewables has fallen. And I think so many of the senior decision makers in many organisations, not just in the energy industry, but in the investment industry, they're not close enough to that to understand it. They haven't seen it and lived it. the way that we do on panels like this. It's always the same people talking who've kind of lived through it. So I think you have to hammer home the message to the people who make the critical decisions about where are we, the strategic resource allocation decisions, whether it be, these are the issues we're going to analyze if you're on the sell side, or these are the asset classes we're going to invest in if you're on the buy side. I mean, it's easier said than done, but it's filtering that message up to the
Sure.
highest ranking decision maker.
So next time in one of those meetings where your CIO or CEO is asking for feedback and they've asked a question, or do you have one question in the room? You now know what the question to ask is. Something about COP, green taxonomy, or what are we doing to be sort of aligned in the world? Do you challenge your CIO and CEO on that, particularly if they are not aware of this kind of stuff? Great. Okay, Nick.
And just maybe going back to the beginning is actually maybe get out of the silos of ESG. I mean, the climate may be an environmental issue, but the transition is not environmental. It's structural economic change. And therefore, the whole issue, the social dimension really needs to be managed. This is the phraseology of the just transition. It's the Gilets jaunes. It's the coal miners in Pennsylvania. So we've got to take climate out of its silo and think about this in a more macro, holistic sense, and linking the environmental and social issues.
Sure. So I guess think out of the silo, be aware of systems thinking, and appreciate the kind of interconnectedness of all of this. Great. So that's a really great note to one, and I'd like to round of applause for our brilliant panelists.